What are interest rates, and why are they important? Monkey was watching videos on the internet. People in the comments are confused. Is cutting interest rates inflationary? This is nonsense, they say. How come prices go up when interest rates fall? Does anyone understand? They say Monkey will now explain this to you. I know you're saying how would Monkey know this, but please watch the video till the end. First, let's ask Google. Is cutting interest rates inflationary? Google says yes. Lower interest rates cause inflation by increasing consumer spending and demand. So how does this happen? Let's say Monkey wants to buy a house. The house costs $400,000. If the interest rate is 7%, the monthly payment is $2,661. Now let the interest rate drop to 3%. The monthly payment drops to $1,686. Wow, it got so much cheaper. Now more monkeys can afford this house. Demand is increasing. What happens when demand increases? Prices go up. Investors also start buying houses like crazy with 3% interest, and inevitably house prices skyrocket. Another example. Now let the interest rate be 0%. Would Monkey keep his money in the bank with 0% interest? Absolutely not. He would lose his money to inflation. So what would he do? Monkey would buy stocks. But what happens if everyone buys stocks? Demand increases. The stock market goes up. This is financial asset inflation because of low interest rates. What if credit card interest was 0%? People would spend more. Demand increases, prices rise. Companies offer 0% financing to increase sales. Monkey has seen these, but wait. If you don't see the full picture, you'll get it all wrong. Important point. Cutting interest rates doesn't always raise prices. Example 1. If the Fed cuts interest rates by 0.25%, this is a small cut. A small effect on inflation. Prices won't surge with such a small cut. Example 2. If the Fed cuts interest rates from 4.5% to 1%, this is a big cut. But what happens if the economy goes into depression? Prices fall. Low interest rates create inflationary pressure, but economic depression creates deflationary pressure. Two forces are fighting against each other. If depression wins, prices won't rise. Now there's something else. Very important. If you cut interest rates, the dollar weakens. High interest rates strengthen the currency. Low interest rates weaken it. If the dollar weakens, import prices increase. Because you need more dollars to buy foreign goods. Think about it. You're going on vacation to Europe. The dollar is strong. If you give $100, you get 120 euros. A nice dinner costs 100 euros. It costs you $83. Now let the dollar weaken. $100 only gets you 80 euros. The same meal now costs $125. Wow, what a big difference. When your currency is weak, the same thing is much more expensive. Think about this on a large scale. Interest rate cut, dollar weakens, import prices inflate. But again, the full picture is important. Cutting interest rates weakens the dollar, but it's not guaranteed to weaken against other currencies. Example, we cut interest rates, the dollar weakens. But if Europeans also cut interest rates, the euro weakens. The effects can offset each other. Low interest rates, weak dollar, but prices don't rise. Another scenario, we cut interest rates, but Europe cuts more than us. The dollar could even strengthen. Again, low interest rates, but prices don't rise. But low interest rates still hurt the dollar. Only Europeans hurt their currency more than we hurt ours. Everything is relative. In the end, low interest rates add inflationary pressure. This is why people say cutting interest rates is inflationary. And it is. Monkey hopes this explanation helps people understand the relationship between interest rates and inflation. Apes together strong. By the way, this is not financial advice. Please don't sue the monkey.